an equity update right now. We do that with Lori Calvasina, head of U.S. equity strategy at RBC Capital Markets. She threatens society with a 70-page PowerPoint.
I'm looking at it right now.
She calls it a deck.
Yep.
It's not a PowerPoint. It's not cool anymore.
No, that's not it.
Lori, what's the newest, freshest chart in the dreaded Calvasina deck?
Oh, don't say dreaded, Tom. I think it's got some fans, and honestly, people who don't want to, read the deck, I think it's 108 pages right now. They can listen to the podcast. It's like 5 minutes, but no, I think, if I look back on recent client meetings, I would say the one we've been talking about the most actually looks at how the S&P 500 performs after a new Fed chair takes over. And what's interesting about that is if you look at Warsh, when he took over in late May, the S&P 500 essentially traded sideways until we got to this month, and we kind of, had to move higher. But we initially put this chart together, kind of right at the end of July. And we actually went back and looked at Powell, Yellen, and then Bernanke, and I got creative with the colors on the chart. Bernanke was in blue, Yellen was in yellow, and Powell was in purple. But we looked at their performance, the stock market performance a year after they, took over, and we did it on a daily basis. And so what we found was that Warsh's three predecessors, the stock market was extremely choppy those first few months as well. Bernanke and Powell, if you go a little bit deeper into their first years, stock market was actually in the red for a decent period of time. But guess what? If you looked at all three of them, the stock market was higher a year later after they walked in the door at the Fed.
See, the problem, she didn't do this right. I mean, if you're going to do Powell in colors, you got to do Grateful Dead tie-dyed, crimson red, cobalt blue, lemon yellow, emerald green, deep violet, and bright orange.
Oh, okay. So, Lori, I'm looking at your deck, and apparently you were in Australia last week meeting with investors. I mean, that's the whole nother side of this planet here. Do they think about in the markets any differently than we do? Do they have any special concerns?
Yeah, so it was week before last, and we put out the recap middle of last week. I will confess I'm still dealing with some jet lag here. Not time zone changes are not my friend. But it was a fantastic week, client meetings. Someone joked they thought I saw basically every investor in Sydney. But the reality is that we talked about three topics, right? One was interest rates, inflation, and the impact on equities. Another was midterm elections. And then the third was the rotation trade. And I would say, on the Fed, I think there was sort of a lot of confusion. We walked them through that chart I just mentioned, really tried to calm people down just a little bit and say it's not unusual, right, to have some indigestion when you get a new Fed chair. On the midterm elections, it was viewed as a risk. I would say that when I talk to non-U.S. based investors, my Australian clients sound a lot like my European clients or my Canadian clients, where they do tend to view the midterms as a risk factor. We get less of that when we talk to people based in the States, though it is coming up in conversations a bit more lately. And then, looking at rotation, I would say the Australian community really seemed to be in the rotation camp, looking for value, non-U.S. to lead. Of course, since the bounce back in late July, the opposite has happened. So it felt like they were sort of fighting the performance. But if you looked at their flows, and we did that when we came back, we are actually seeing better flows to Europe than the U.S. from the Australian-based equity funds.
Lori Calvasina with us across America. Good evening across Australia from Perth over east. I think it's east to Cindy as well. Lori, I'm looking at long-term bonds unravel, price down, yield up. I got an Australian 30-year from the pandemic, Australian 10-year going from 1% to 5%, buttressed up the new highs. What do long-term bond higher yields mean for stock market participants?
So it's a great question, Tom, and I'll tell you that the bias in Australia was they thought even our interest rates here in the U.S. were destined to go up. They thought the Fed was going to hike. Again, my conversations were before that NFP report that kind of, threw some cold water on that idea. But that was really kind of the mindset they were in. What I told them is what I've been telling U.S. investors, which is whether you're looking at it through the lens of the 10-year yield or the Fed hiking potentially, the U.S. equity market can handle a little. It can't handle a lot. And so, basically our modeling suggests we can handle, sort of up to 4 hikes from the Fed in a 12-month time frame. So, sort of spread out over that 12 months or that, 10-year yields that, stay below 5%, but don't necessarily go down from here. We think we can also handle that. And if you think about sort of inflation, interest rates, the Fed, all those things moving up puts pressure on the PE multiple, but the earnings outlook is so strong, it can really offset that pressure. And so that's what we really, we're kind of walking people through, is where is that tipping point?
So what we're not talking about a lot, I think, is valuation, Lori. I mean, is that just simply because earnings have been so strong that valuations really aren't that much of a concern at this point?
Yeah, my charts, honestly, in the aforementioned 108-page deck, the valuation charts are really not that interesting right now, and that's, I think, probably a good thing. We had seen at various points earlier this year that whether you were looking at the S&P, the NASDAQ 100, S&P top 10 market cap names, which is a good proxy for the AI trade, or even Russell 2000 right before the reconstitution, that you had various points, right, where we were sort of at the high end of the post-COVID range. And then we've had other points where we're sort of at the low end of the post-COVID range or getting close to it. Some of those charts keep making higher and higher lows. But the reality is things look fine on the valuation data right now, neither frothy nor washed out. So they're not terribly interesting charts, but that does give the equity market some room to move up. And I do think that is, a function of a couple things. Is one, again, this higher rates and inflation environment that people are anticipating does put some pressure. Geopolitical uncertainty, when that rises, puts some pressure on the PE. But at the same time, we've got this dramatically strong earnings environment, and the forecast just continue to get ratcheted up.
Do you model that out into 2027?
So with our one model that we use as part of the derivation of our price target, we just the brilliantly creative name of valuation earnings model, not that interesting, but we do model that in right now to 2Q27, and we actually take the bottom up consensus earnings, haircut it by 10%. Your typical haircut is about 8%, so we're doing a little bit more than that, and then we're still modeling in. This is for 2Q27, but we put in 3% on CPI, we put in 2 hikes, and we put in 4.75 on 10-year yield. So we get a bit of multiple compression, but that model, which I would argue is really, really conservative at this point, can put you to 80-43. Other models that we have go higher, up into the 83, 100 plus type range for the S&P. So our target is actually 81.50. But we've really been using that model to say, put everything you're afraid of down on paper, not doom and gloom, not Armageddon, but, the reasonable things that might have a chance at happening. We still see a path higher for stocks.